So today's lecture is a very short and very lovely and easy to understand. Today we are going to see how to value resource firms. Okay, have a look at this figure. It represents, we have here a diagram that represents the trend or the level or change in the commodity prices obtained from the website of the Reserve Bank of Australia. As we can see, prior to 2005, there was little change or no very clear trend. After 2005, there was an upward trend. Then in 2008, when the global financial crisis hit the world, we have a reversal down. Then again, in 2009, there was another move up because of the recovery in the global economy. Then again, we have another downward trend because of the European crisis and the slowdown in the Chinese economy. Resource firms usually aim to find, develop, and extract mineral resources. Extract and sell, of course, okay? So extracting, it is for the purpose of selling, okay? Remember that mineral resources are usually defined as an economic occurrence of an element in nature. Usually there are certain steps followed by these resource firms in order to achieve their ultimate objectives. The first one is exploration. Exploration means searching for. They are searching or looking for. Okay? A lot of money is spent every year in order to find valuable resources or resources that are feasible to extract. The second step, once the result of the exploration is positive, the second step is to define what we found, right? In terms of the quantity and the quality. So the second step is the definition. We should define the resource found in terms of the quantity and the quality. The next step is to do feasibility studies to see if it is feasible to extract. Of course, we cannot do feasibility study before we decide the quantity and the quality, right? Because quantity and the quality can tell the value of the underlying, right? And once we have known the value of the underlying resource, we can easily do the feasibility study and see whether it is expected to earn a return greater than the cost. If it is feasible, the next intuitive step is the development. Development means we prepare the area or the site for extraction and production. Okay? We prepare the area. Some firms, they do open cut or underground mining or production wells. The next step is the extraction. We start extracting the underlying resource. by removing it from the surrounding rock or waste. Some firms, they do on-site processing or refining to remove the waste, and some firms, they do further refining, maybe to make the underlying resource ready for use, maybe something like that, okay? So this is just preliminary cleaning or refining, and this one is more advanced, okay? Resource firms, they are different from other firms in many areas. For example, the volatility of share prices. Usually, these firms, they earn higher rate of return in the short run, but of course, the share prices of these firms are more volatile than other firms. The second difference is the exploration. These firms have to do exploration to stay in the business and continue. Otherwise, they cannot survive. Okay? They have to. The reason is that usually the resources these firms extract and sell, usually they have finite quantities. And therefore, once this area, for example, is exhausted, once the resource discovered in this area is exhausted, the firm should search for another area and do or start the process all over again. So they have to do exploration continuously. These firms have to do exploration continuously. They are always in search for new reserves. Again, this one is related to this one. Usually these firms, they deal with finite reserves. Now, these reserves could be exhausted within a period of time, and this depends on the production rate. Some firms, they have large scale productions or extractions. It depends on the production rate. Another source of uncertainty or volatility which these firms usually encounter is the volatility in the commodity or resource price. And that, of course, depends on the supply and demands and the economic conditions of the overall economy as well as the global economy. For example, here in Western Australia, we know the story, we know what happened over the past few years. The slowdown in the Chinese economy hit the mining sector severely in Western Australia, right? We have a problem. We used to have a boom a few years ago, but after 2015 or 16, the boom was shrinking, and we have now a problem here in the mining sector. You are aware of this problem, huh? Okay. Most exporters or resource firms are usually price takers. By the way, the discussion in this lecture applies to our firm in the assignment, BHP, because it is a resource firm. Okay? So most exporters are usually price takers. They cannot determine the price as they wish. This is the meaning. Price takers means that there is high competition in the market. Remember, price takers means price takers, it means that there are many competitors and high competition in the market, so there is no single firm that can determine the price as it wishes. Okay? This is the meaning of a price takers. And the price makers means that there is only one or a few players in the market, and they can decide the price as they wish. They can determine the price, okay? Maybe just one or two, or just very few suppliers. So the competition is very low, and that's why this is when we call it price makers, okay? So in the resource market or commodity market, usually firms there are price takers because of the high competition. Also, capital intensity. Capital intensity means that these firms, they have a lot of tangible assets, fixed assets, physical assets. Of course, that makes sense because these firms, they have a lot of equipment, they have a lot of machines, they have a lot of drilling machines, they have a lot of vehicles, and the trucks, and they have a lot of also maybe on-site housing complexes, okay? Some mining firms, they have like small cities next to the mining sites to accommodate their labor or employees, right? Right? So they have a lot of fixed assets. These firms are also usually heavily monitored by the government and regulated. Why is that? Because of their impact on the environment. They are usually heavily regulated and monitored by the government because of their impact on the environment. So these firms usually are obliged to write their environmental impact statement. In this statement, the firm should describe the impact on all aspects of the environment, including air, water quality, noise, disposal of waste. So the firm should explain to the public and to the government how it is going to deal with these issues. Some governments around the world, some governments impose a tax on the carbon dioxide emitted by these firms, okay? Because of the pollution, the effect on the environment, okay? Here, this tax was imposed actually in Australia during the government of Julia Gillard, I think. Then later on, Tony Abbott abolished the tax, okay? Right? If I'm not mistaken, yes. These firms are also obliged to deposit a bond with the government, much similar to the concept of the bond when you rent a house. When you rent a house, you normally pay a deposit or a bond to the real estate agent. The real estate agent at the end of the contract, at the end of the lease or rent contract, will come and inspect the house. If there is anything wrong, they will fix it and then deduct the cost from the bond and retain the residual. The same applies here. These firms usually they deposit a bond with the government or an amount of money. At the end of the lease or when the production is over, the government normally sends agents to check the site and make sure that the firm cleaned all the mess and retained the land to normal conditions. If there is anything wrong, the government may do something and subtract the cost from the bond and refund the residual to the firm, okay? Another issue is the right to the land or in the land rights. You need to be careful here, make a clear distinction when you do valuation. Make sure that the firm, or double check and see whether the firm owns the land or just the firm has just the right to exploit the land, okay? Because it makes a difference in terms of when it comes to valuation, right? Having the right to exploit the land is not the same as owning the land itself. So you need to make a clear distinction between the two when you value these firms. We are about to finish, by the way. No need for a break, huh? We can finish in 1 hour, huh? We can finish by 3 o'clock. You like it? Okay, no need for a break, huh? Okay. Happy? I'm spoiling you before the end of the semester. Okay, now as financial analysts, we need to know how to value these firms. Now, the value of these firms can be decomposed into 2 components, and then we can value each component separately, then combine them together. So, resource firms generate cash flows from existing developed resources. So these firms, usually they have existing developed resources, and they have also existing undeveloped resources. Developed resources are those that already producing or extracting and producing cash flow. Undeveloped resources are there still untapped resources, untapped. The firm hasn't done anything. It has been proven that there are a lot of quantities or resources in this site, but the firm didn't do anything or hasn't done anything so far. So these are untapped resources. Okay? Now these undeveloped resources, the firm has the discretion to decide when to develop and start the production, right? Now this discretion gives the firm the right rather than the obligation, or makes the situation much similar to the call option. Are you aware of call options? Call options, they give the holder the right to buy something, the right, not the obligation, the right to buy the underlying asset at a predetermined price on or before a predetermined date. Okay? The predetermined price is usually called strike price or exercise price. And the predetermined date is usually called expiration date. Now for the existing resources, for the existing developed resources, they can be valued easily using our familiar valuation models. We can use, for example, the DCF model, we can use the DDM model, we can use the residual earnings or residual operating income model. Any of these can be used. We can also use the method of comparables, using some very popular multiple ratios, popular in this sector, such as, for example, the enterprise value relative to the resource value, the enterprise value relative to the reserve value, the enterprise value relative to the EBITDA. You know the meaning of EBITDA? Earnings before interest, tax, depreciation, and amortization. And the price to earning ratio. So any of these multiples can be used to value the underlying firm. We use multiples for the comparable firms. We take the average and then apply it to value the underlying firm. Okay? There are, or the key value or drivers of value include money, like the quality, quantity, proximity to infrastructure, commodity prices, life. So these are the major drivers of value for these firms. So we know how to use these models in valuation. So we are not going to discuss them here. We know how to use them. So what we need to know is how to value the second component of value, the value of the undeveloped resources. This is what we need to know. Undeveloped resources, if the firm, for example, or the payoff from developing these resources is equal to what? Is equal to V minus K. V minus K, where K is the cost of developing these resources and V is the value of the underlying resources. So V minus K is equal or gives us the payoff from these resources. However, because these firms, they have the discretion. They are not obliged to develop unless V is greater than K. It follows that these firms will not develop unless V is greater than K. If V is less than K, these firms will not develop. And in this case, the firm will not lose any money. The loss is zero. As such, the payoff from this option is equal to the max of 0 and V minus K. Max of 0 and V minus K means that we take the higher of the two values. If V minus K is positive, then the result of this argument is V minus K. This is the case when V is greater than K. If V minus K is positive, this is the payoff, V minus K. And if V is less than K or equal to K, in this case the firm will not develop and will not do anything, and the payoff here is zero. Okay? Make sense? The firm is not obliged to develop unless the payoff is positive. Okay? This is the diagram showing how the net payoff looks like. This is the cost of developing, and then there is a point when we take, this is here the cost of developing, we need to take also into account the production cost. So there is a point here when the net payoff is equal to the cost, and then beyond that the net payoff becomes positive. Make sense? Okay. So let us see how to value these undeveloped reserves. To value these firms, we use the option valuation model because, as we have mentioned before, firms are not obliged, firms have the discretion, and therefore the payoff from these undeveloped reserves, the payoff is much similar to the payoff of a call option. As such, we need the inputs to use in the option valuation model to value these firms, or to value the undeveloped reserves. We need an estimation of the value of the underlying resource, net of production cost, net of production cost. Let us call it S. So S at time t, st, small t here, means the current value of the underlying resource. Okay? K is the estimated cost of developing the resource. T is the time to expiration of the option. Here we take the shorter of the two periods. The time period under the rise to the reserve or the time until the reserves are exhausted, whichever is shorter. Make sense? So for example, let us say that the reserves are expected to be exhausted in 30 years, but the firm has the right to exploit the land for 20 years. In this case, we use T equal to 20, because the firm has the right to exploit the land for 20 years only. Even if the reserves will be exhausted in 50 years, it doesn't matter. Okay? And if the right is 30 years, for example, and the reserve is expected to be exhausted in 15 years, then we use 15. So whichever is shorter, we look at the two times or periods and take the shorter of them. Okay? Make sense? Okay. Sigma square is the variance of the natural logarithm of the value of the underlying reserve. D is the cost of delay. It is equivalent to the convenience yield, or sometimes it is called convenience yield or net production revenue. It is equivalent to the dividend yield used in option valuation models. If you still remember, there are many definitions of the convenience yield or the cost of delay, but the simplest one is this. It is here, once the reserve becomes viable, D is what the firm is losing by not developing the reserve. Okay? So this is the loss to the firm if the firm decided not to develop and extract and sell the underlying reserves or resources. Make sense? It is like the opportunity cost to the firm. Make sense? Okay. RC is the continuously compounded risk-free rate. In the exam, if I do not say this is per annum basis, okay? In the exam, if the question doesn't say that the interest rate is continuously compounded, you can assume it is already continuously compounded, okay? You do not have to do conversion. You do not have to convert the interest and make it continuously compounded. Nevertheless, for your info, if you are interested in how to calculate the continuously compounded risk-free rate, all you need to do is to find the effective risk-free rate on a bond, government bond, that has a maturity similar to the expiration date of the option. For example, here let us say that T is 20 years. You need to find the risk-free rate or the interest rate on a government bond that matures in 20 years or close to 20 years. Once you have derived the effective interest rate, you can convert it into continuously risk-free rate as follows. RC is equal to natural logarithm of 1 plus the effective risk-free rate, okay? So RC stands for continuously compounded risk-free rate. RE, this is the effective risk-free rate. You can derive it from the government bond that has a maturity similar to the expiration date of the option. So once we have determined or defined the inputs, the next step is to apply or plug the inputs into the option valuation model. Remember the Black-Scholes-Merton model, sometimes it is called BSM model. According to this model, the value of the option is equal to the current value of the underlying asset, underlying the option, times e to the power negative dt. Remember, negative d is, remember that d is the cost of delay, t is the time to expiration, times nd1. nd1 is the area or the probability beneath d1 calculated from the standard normal distribution table. So the first step is to calculate d1 according to the following formula, and then we need to find the area or the probability from the probability beneath D1 from the normal distribution table, as we shall see shortly. I will show you how to do it. Very simple. Very simple. Minus K times e to the power negative RC times t. So this is the continuously compounded risk-free rate times the time to expiration times the area beneath D2. So D2 is calculated as follows. It is equal to D1 minus the product of sigma and the square root of t. So once we have calculated D1, then D2 becomes D1 minus this quantity. Okay? Mathematically, the area beneath D1 or ND1 is the multiplied by this quantity is the first derivative of C with respect to S. That is equal to it shows us the change in the value of the option given a change in the value of the underlying resource. This is the meaning, okay? This is the meaning of ND1. And the meaning of ND2, it gives us the likelihood that the option will end in the money. For the call option, it gives us the likelihood that S will be greater than K. And so the option is in the money. And for put options, it gives us the probability that the K is greater than S, okay? Don't worry about these ones. These technical details, you do not need to worry. Just make sure that you understand the model and how to apply the model in valuation. If you are interested in these technical details about options and the derivations and the first derivative, you should take FINA 2204. I like this unit. I taught it for 6 years. It was my favorite unit. Okay, let us refresh your memory. Let us see how to use the BSM model and how to use the normal distribution table to find the probability or the area under D1 and D2. Remember that the normal distribution is a bell-shaped curve. It is symmetric. It is symmetric around the mean. This is the mean in the middle. So if we fold the two halves around the mean, the two halves are identical. Mirror image, right? So that's why it is symmetric around its mean. So the area under the whole curve is equal to 1, and the area in each half is equal to 0.5 or half. Okay? If D1 is positive, we can approximate D1 to the nearest 2 decimal places. This is what I want you to do in the exam. You always approximate the calculated D, whether D1 or D2, it doesn't matter. Just round it. Round it. We can. It would be better to use round. We can round D1 to the nearest 2 decimal places and find the area beneath it from the table directly. Okay? This is better, I think. A more suitable word, huh? So round the calculated D to the nearest 2 decimal places. Example, assume D1 is 0.1743. How to round it? Very easy. It is 0.17. Right? Because 4 is less than 5. If this one was, if the third place was 5 and above, we round it to 0.18. Okay? Okay. Make sense? Now, once we have rounded to 2 places, we locate the first place. The first place is 0.1 from the table. So we have 2 places here. We have 0.1 and we have 0.07, right? So we locate the first place. This is the first place, 0.1. And from here, we normally locate the first place from the first column on the left-hand side, okay? This is the first column where we locate the first place. And from there, we move to the right and locate the area that is at the intersection of the 2 places. For example, the second place is 0.1, the first one is 0.1, the second is 0.07. So this is the first place. From here, we search for the second place. This is the second place, and this is the intersection. So this is the area where or under 0.17. Okay? Make sense? If the area, for example, let us assume D1 is equal to 1.6734. How to round it? We round it to 1.67, right? So we locate it here. This is 1.6. This is the first place, or first and second place, or let us say first place to the right of the dot. From here, we move to the right to locate the second place. It is again here. Okay? Okay. Now, note something. If D1 and also D2, whatever, if it is negative, then the area beneath it is equal to 1 minus the area under positive D1. Okay? The reason is that the table here, the table here gives us the probability beneath positive values of D. Okay? We do not have the area beneath negative values of D. We just have the area beneath positive values of D. So, for example, if D is negative, for example, negative 2, and we are interested in finding the area here, we know that the area here beneath negative 2, because the curve is symmetric, we know that this area is similar to the area above positive 2, right? But the table doesn't give us the area above. The table gives us the area below. So the area beneath positive 2. This area beneath, so the table shows us this is positive 2. The table gives us the area beneath positive 2. So how to find this area above positive 2? It is simply 1 minus, because the whole area is 1. So 1 minus all of this area beneath positive 2 gives us the area to the right of 2, which is similar to the area beneath negative 2. Make sense? Okay. Make sense? Okay. Okay, let us use a numerical example. An offshore oil company has estimated oil reserves of 50 million barrels of oil. The cost of developing the reserve is approximately 600 million. Development development lag, this is a new point to us. The development lag is 2 years, and the company has the right to exploit this reserve for the next 20 years. Did I drop something? The marginal value, the price per barrel less the marginal production cost per barrel, is currently $12 per barrel of oil, so this is S0. Once developed, the net production revenue each year is 5%, so this is D. The risk-free rate is, this is the risk-free rate is 8%, and the variance in oil prices is 0.03. This is sigma, okay? And this is K. Note that this is just S without per barrel. Be careful, this is the value per barrel. So you need to calculate the total value of S, and you need to multiply 12 by the 50 million. I will show you how to do it shortly, okay? So S0 is equal to 12 times 50. 12 times 50. S0 is equal to 12 times 50. The price per barrel, or the marginal price, net of the production cost, times the quantity, the number of barrels. Okay? So this is a summary of the former question. Note, so current value of the asset, S is equal to 12 times 50. Here, note that there is something called development lag or delay. It takes 2 years to develop. So if we assume, so production is expected to start in 2 years. Production is expected to start in 2 years. However, we are using the current value. So the implied assumption here, there is an assumption here, is that the price in 2 years is the same like the current price. If this is not the case, then you need to forecast. You need to forecast the price in 2 years and use it, discount it to the present, and use it in the valuation. Okay? How to discount it? We discount it using the development lag or the cost of delay. So we divide the value expected in 2 years, we divide it by 1 plus the cost of delay. 1 plus the cost of delay, this is 1 plus the cost of delay, 0.05, to the power 2. 2 is the development lag. So this is the development lag, and 5% here. So this is ST divided by 1 plus D to the power lag. So this is how we do it. We develop the value of the asset expected in the future when the production starts. We divide it by 1 plus the cost of delay to the power development lag. This is just an arrow to show you that we use here as a power, we use the lag. It is not a negative sign, be careful, okay? Make sense? Okay. Again, for simplicity, in this question, we assume that the value in 2 years is equal to the current value. If this is not the case, you need to forecast the value of the underlying or the price in 2 years and use it in this model. K is the 600 million. Time to expiration on option is 20 years. The variance is 0.03. The risk-free rate is 8%. The cost of delay, D, is 5%. So all the inputs we need are there. All we need to do is to plug them into the model. First step, we calculate D1. D1, and take my advice, when you calculate D1, do not try to find the final result in one trial on your financial or scientific calculator. No, I do not advise you to do that, because if you incorrectly close the parentheses at any point, whole results will be wrong. Take my advice. Calculate each component one by one. Calculate the component, the value of this one, and the value of this one. Then take the sum. Then divide the sum by the denominator. Okay? That is much easier for you to avoid calculation error. I did a unit advanced derivatives when I was doing my PhD at Melbourne Uni. Advanced derivatives securities, and I lost maybe 10 marks because of silly calculations errors like these ones. So sometimes it is very painful to you to lose a lot of marks because of calculation errors, especially if you understand the question but you lose marks because of silly errors like this. This is very painful. Okay? So you divide this one by k, and the answer, you find the natural logarithm of the answer. Then you add the result here to the result here, and then you divide the sum by this one. Remember that sigma is just the square root of sigma square, or the variance. Okay? So sigma here is the square root of 0.03. And it is equal to 0.1732. So this is D1, and we can round it to how much? How to round it? 1.0 or what? 04, huh? That's true. Okay. And this one, we can round it to how much? D2, how much? 0.26. Okay, that's fine. And this is the area beneath. This is the area under 1.04. And this is the area beneath 0.26. Okay? We plug them after we have calculated D1, D2, and we found the area under each. We plug them into the model. So this is the adjusted price or value. Adjusted for whom? For the development lag, because we have development lag here. Okay? If the question doesn't mention the development lag, you do not have to do this adjustment, okay? So in the exam, do not be confused. You may see something like this in the final exam. You may see something like this. If the question doesn't say anything about the development lag, you can assume that there is no development lag. Okay. And this is the answer. 97.34. This is million, okay? If you want to calculate the exact area under D1 or D2, you can use this command in Excel. Put norms equal norms dist between brackets or parentheses the value of D, and then hit enter. The Excel will give you the exact area, okay? There are some scientific calculators that can also give you the exact area. This valuation method is called real option valuation. Real option valuation. one complexity in valuing real options is the source of uncertainty. In addition to the variance in the value of the underlying resource, there is another source of variance, and that is the quantity of the reserves discovered. So there are two sources of uncertainty in terms of the price and the quantity. Make sense? So two ways to deal with this problem. The first one is to combine the two together. The second is to keep each variance separate from the other and value the option using or treating the option as a rainbow option. Rainbow option allows you to value the option assuming that there are two sources of uncertainty. Okay? However, this topic is very advanced. It is just for your info. If you are interested in something like this, you can consult another more advanced textbook. Okay? In this unit, it is enough to know the basics of valuing mining firms. So once the developed reserves of the firm are valued using real option valuation, then the value of the firm or its operating assets can be calculated as the sum of the two values, the value of developed reserves and the value of undeveloped reserves. And the value of equity is just the difference between the value of the firm minus net debt. Okay. Note that real option valuation model, normally if you value a project using real option valuation and also net to present value or discounted cash flow method, normally the real option valuation method gives you a higher value than the other method. Why is that? Because it is protected from the downside risk. It is assumed that you will not develop unless the payoff is positive, right? This is not the case under the DCF. Under the DCF, we assume that you will, or the firm will do production in all cases, whether the payoff is positive or negative, and we use the expected value. The expected value or the expected cash flows in the future are based on worst case scenario, most likely scenario, and best case scenario. Okay? Worst case scenario maybe yield a negative cash flow. Okay? So when we calculate the expected value based on these three scenarios, the value obtained will be less than the expected value obtained from real option valuation, because real option valuation excludes the possibility of a negative scenario, either positive or zero. There is no such negative, because the firm is not obliged. The firm is not obliged to develop the reserves if the payoff is negative. Okay? So either if it is zero or positive. The difference between the value obtained here and the value under the NPV or DCF is the value of operating flexibility. Here we are talking about here. The value of operating or management flexibility. This is the advantage. This is the advantage of this one over this one. It is better in dealing with uncertainty and operating flexibility. The difference between the value obtained here and the value here, DCF is the discounted cash flow method. Okay? DCF is the discounted cash flow method. So the difference between the value obtained here and the value obtained here is the value of operating or management flexibility. Okay? Done. Perfect. 1 hour, as I promised. Still 1 minute to go. You can't leave. Stay. Okay, so this is an exercise for you. Please make sure before you leave, attention, Please remember, tomorrow you have the last RAT assessment. This is one issue. Another issue, unfortunately, last week I sent a reminder, and the week before I sent a reminder to remind you of the deadlines for the assignment and the Spark. Some students, they haven't done a Spark until now. They missed the deadline. So we decided to extend the deadline until next Monday. If you haven't done so, please make sure that you do it. This is another point. Attention, please. Attention. Please also make sure that you upload your presentation slides on LMS. I sent you an email about it, okay? The presentation slides, because we need them for accreditation. This unit is very important for accreditation. It is a very important unit. And some accreditation institutions, they require evidence of what we are teaching and expecting from students to do. So we need the presentation slides uploaded on LMS. There is a submission point there in the very same folder where the assignment is located, okay? Besides, next week is your last lecture. Make sure that you come, because I will give you the final exam tips next week. I will give you beautiful tips that will help you to deal with the final exam and answer your queries about the exam. And what else? What else? Just remind me. My memory card needs formatting. Okay, I will see you next week. Make sure that you come next week, please, okay? What? It is given to you in the question. It is the same as the net production revenue. Go back to the definition, okay? Sometimes it is called net production revenue, sometimes it is called cost of delivery, okay?
Here it's 5%, so it doesn't matter how many years.
It doesn't matter. This is an opportunity cost that exists all the time. Even if the firm started the production, still the production today, there is a cost involved because we cannot extract and produce all the reserves in 1 year. So every year there is an opportunity lost, an opportunity cost for the remaining years, okay?
So it doesn't matter if they're developing in like in 20 years, it's, the cost is still 5%.
Is this week and next week lecture going to be on the exam?
We have a lecture after the lecture. I will give you the tips for the final exam, okay? Yes, make sure you come, please. Yes, ma'am.
It's about the Spark thing. So is it going to be open later tonight, later today?
It will be open until next Monday, okay? We will put you, send you an announcement to tell you it is available until next Monday, okay? So please make sure that you do it. Okay, guys, have a good day. Bye-bye.
Why do you report it? But I didn't report it.
He left the unit, but Scott is still in our quá. 明天啊。不知道。好烦。明天我去上课。我能不能跟他说，我们3个去来跟我说，我觉得再往前给3000块钱给你。3箱 AMG 和2箱 AMG 有什么区别？我不懂。只有一种可能会有这种情况，只有 A 系会有这种情况。我不知道啊，有吧？你看，男人眼中463 GLA 45 GL 163，爱车的女孩眼中3箱 AMG、2箱 AMG、SUV AMG， 女孩眼中白色奔驰。这个不是2箱 AMG 啊，3箱，第一个是3箱，第二个是2箱。那个也不是2箱。我不知道。第二个是 GLC 啊。我不知道。哎，对啊 ，GLC 啊 ，GLC 啊 ，GLC AMG 啊。我不知道。那为什么叫做3箱和2箱？那个不能理解为2箱。我都不知道。